Hello everyone, I'm Nova Lui, Head of Investor Advisory at RHB Bank. Welcome to our monthly Investment Insight podcast. Geopolitical tensions in Middle East sparked at the end of July when the assassination of Ismail Haniyeh, one of Hamas' most senior leaders. Tension escalated with Iran vowing a revenge, which heightened the fear of a broader conflict in Middle East, adding to global market volatility. The Bank of Japan raised interest rate on 31st July to the highest point in 15 years, challenging the yen carry trade and causing significant market disruptions. This move led to the yen appreciating against the US dollar and other currencies, forcing investors to unwind carry trades by selling down equity and US dollar. Weaker than expected US employment data released on 2nd August 2024 show non-farm payroll increasing by only 114,000 in July, with the unemployment rate rising to 4.3%. This data raised concerns that the Federal Reserve was behind the curve in its monetary policy, contributing to a negative reaction in equity markets. Equity market experienced significant declines, with the MSCI All Country World Index and S&P 500 both plunged over 2%. Technology stocks were particularly hard hit, with the Nasdaq Composite falling by 13% since its peak last month. Japanese stocks steep declines, with the Topix Index falling 12.2% on 5th August, which is its sharpest decline since Black Monday in October 1987. Asian market, particularly tech-centric markets like Taiwan and Korea, also face selling pressure due to unwinding of the carry trade and growth concern in the US. With a series of events over the month, Nikkei 225 has lost almost all its gain for the past 1 year. Developed markets are more relatively volatile compared to emerging markets, which are relatively less impacted by these drops. The bond market rallied as investors sought refuge in fixed income securities amidst market volatility. Yields on short-term treasuries such as 2-year yield dropped significantly. In the US, 10-year treasury yield declined from 4.15 to 3.75%. Malaysia ringgit bond yield followed the collapse in the 10-year US treasury, with the 10-year MGS breaking below the 3.7% floor. Credit spread widened in sympathy with the equity sell-off, but there was no panic selling in high-yield market, indicating a cautious but stable environment. Market participants are now expecting the Fed Reserve to implement several rate cuts by the end of the year, with the market pricing in 3 times rate cut by this year of 125 basis points, while our house view is revised from 1 to 2 times rate cut by this year of about 50 basis points. The narrative has shifted from a soft landing to concern that Fed may have waited too long to ease monetary policy, significantly increasing the odds of a recession. Historically, markets tend to rise when Federal Reserve rate cuts are not followed by a recession. We believe the global sell-off do not accurately reflect the relatively resilient global economy. As such, fortune will likely favor the bull. We advocate buy at dips for dealer market equities, especially US-centric, on the back of our relatively positive global economic growth assumptions. 1 month disappointment of US-centric labor market should not have been the key catalyst behind the sudden pessimism, and so the softer data is part of the normalization pattern towards the long-term averages. Recent pullback on global equity, especially on the technology sector, creates interesting buying opportunity both within the mega cap space and in small and medium cap names where cyclical expectation and AI spending expectation have now reset. Broadening out investment theme appearing more relevant with valuation across different sectors in US equity market is now more attractive. Japan equity market has shown encouraging recovery post the massive sell-down on 5th August, while the US equity market has turned green, signifying some relief in the equity market. Addition of Japanese equity exposure within developed market and India equity within emerging market remains as an attractive inclusion for investors' portfolio. Meanwhile, in Malaysia, Despite external risks, Malaysian economy is on the firm path of progress with improving data points, increased FDI, higher tourism number, resilient consumer spending, political stability, and mega names such as data center, infrastructure spending, and Johor teams remain intact, providing a cushion against external shocks. If the market weakens significantly, it represents an opportunity to accumulate fundamentally strong companies at cheaper valuation. Despite rally on bond prices, price level remains below its 5-year peak level. The focus remains on investment-grade bond rather than the high-yield bond, which are more susceptible to sell-off in the slowing growth environment. However, bond investors need to be cautious that too much of expectation on rate cut has been priced in, which may create volatility in short term. Alternatively, investor that is seeking for income may get exposure in REITs or income and dividend yielding equity strategy. With the latest update we shared, we aim to provide a clearer picture of recent market dynamics. Markets do not move on straight line. The VIX index has shown that fear index spiked to its highest level since 2020 during the COVID-19. Looking back, investors who invested during the VIX spike in March 2020 would have ended up in positive gains close to 30% within 1 year down the road. Our view of focusing on income investing strategy remains intact. Please view our Q3 Fund Discovery podcast to know more how you can position your portfolio, and read our August merge article, Taming Risk for Rewards, to know how fund managers can protect their equity portfolio from a volatile market. Finally, I hope my insights have provided valuable information to help you make a more informed investment decision. Please reach out to your relationship manager to explore how this idea can be integrated into your diversified portfolio. See you again in our next podcast.